Welcome back to the deep dive. So today we're tackling something huge. How to actually survive, maybe even thrive in today's kind of crazy markets. You sent us this great list, 10 essential rules for retail investors. And the big question is, how do you use these? How do you navigate stocks, crypto, all that stuff without just getting swept up in the noise, the drama, and let's be honest, the FOMO?
Yeah, the FOMO is real. Our mission here is pretty clear. Take these rules, this wisdom you found, and boil it down. We want to create a solid guide focusing on discipline and, crucially, managing your risk. Think of this deep dive as like a shortcut to getting that level-headed investor mindset, turning rules into actual strategy you can use.
And what really jumped out at me from this list is the immediate contradiction almost. Like, the first rule demands this massive effort, tons of research, but then the next one basically says, hey, maybe just do nothing. It's a bit of a paradox, right? Maximum effort leading to strategic inaction. Okay, let's start with that foundation. Rule 1 hits you right away. Information is the most valuable commodity. But this isn't just like scrolling through Twitter or Reddit, is it? The way it's phrased feels much more intense, almost like you need inside info.
Well, not inside info in the illegal sense, but proprietary to you. The sources are really clear on this. If you own an asset, stock, crypto, whatever, you need to actively hunt down every key piece of intelligence about it. We're talking fundamentals here, not just the daily chatter.
Okay, but let's get practical. How does someone actually do that? I mean, reading every single 10Q filing, every white paper update, that sounds like, well, a full-time job. Homework nobody wants.
Look, it is a commitment. But that's the difference between just speculating and actually being an informed investor. The sources get specific. Join earnings calls. Actually read the annual reports. Listen to those investor presentations. The goal isn't just reading volume, it's clarity. You absolutely must know why you're invested. What would make you sell? If you skip that work, you're just relying on hope and hope. Terrible investment strategy.
Wow, okay. That definitely sets a high bar. But then, bam, Rule 2 flips the script completely. If Rule 1 demands all that intense effort, why does Rule 2 immediately say sometimes the smartest move is to do absolutely nothing? That feels weird.
Because the market kind of feeds on your activity.
Yeah.
Our sources point out something really critical. Very, very few investors actually beat the big market indexes over the long haul. That constant urge to be doing something, trading all the time. Statistically, it's often a losing game.
I get the psychological traps, It sparks FOMO, makes you react emotionally. But there's a mechanical side too, right? Constant trading is just plain expensive.
Exactly. Trading costs, taxes on short-term gains, even just missing out because you fiddled with your position too much.
Yeah.
It all adds up. It eats away at your returns. The source material calls passive investing, index funds, the OGs of the game. And there's a reason for that. They harness compounding. They sidestep all those mental traps active trading sets for you. Patience here isn't just nice quality. It's like a real competitive advantage. Measurable. So we've got research and patience down as the base. Now we absolutely have to talk about managing the downside, the risk. Rule 3 is emphatic. Always respect the RRR, the risk-reward ratio.
Right, and the sources were really sharp about the differences here. Not all money activities are the same.
Not at all. They drew huge distinctions between long-term investing, short-term trading, and, well, just gambling. And the warning, it's pretty stark. If you take a gambling approach, ignoring the odds, ignoring risk, and apply that to your serious long-term investments, you will lose money, period.
Okay, for someone listening who maybe knows the term RRR but hasn't really put it into practice rigorously, how can we quickly define that? What's the core idea?
It's all about asymmetry. Simple as that. You're looking for setups where your potential upside, your reward, is way bigger than your potential downside, your risk. Never risk $1 just to maybe make 50 cents. That's a bad bet. If you risk $1, you should be aiming for like $2, maybe $3 in potential gain. RR forces you to step back, look at a position objectively, and ask, does the potential win justify what I could possibly lose here?
That focus on the downside really leads us straight into Rule 6. And honestly, I think this might be the most powerful line in the whole list. Not losing money is more important than making money. But wait a second, if the only goal is not losing money, why invest in anything riskier than, say, government bonds or just index funds? How does that help someone looking for real growth?
Because of the math, the painful math of recovery. Our sources stress this because small losses, you can bounce back relatively easily. Big losses, they require huge, exponential gains just to get back to even. Think about it. Lose 25%, you need a 33% gain just to break even. Suffer with 50% loss, you need a 100% gain just to get back to where you started. So preserving your capital, avoiding those big hits, it's mathematically smarter. It keeps you in the game. It means the hole you might have to climb out of is much, much shallower.
That completely reframes things. It's like playing defense first, then offense.
Precisely. Protect your capital. Manage that risk. Because, as the source material puts it so well, capital and liquidity, they buy you freedom. That's the real end game here.
And protecting capital sometimes means admitting you messed up, right? Rule 5 tackles that psychological hurdle: never throw good money after bad decisions.
Yes. This one goes straight after a cognitive bias called anchoring. It's so common. You buy something, it goes down, but you can't sell because you're mentally stuck or anchored to your purchase price. You refuse to accept the loss. Our sources say, look, buying the dip sounds cool, but you should only add to a losing position if your original reasons, your thesis, are still rock solid. Fundamental reasons. Never just keep feeding a losing bet out of sheer stubbornness or because you don't want to admit you were wrong.
And the warning about using leverage here felt particularly strong.
Oh, absolutely. If you're already leveraged up, throwing more borrowed money at a bad position, that's just digging your own financial grave faster. You're far, far better off adjusting your risk, maybe cutting your position size down, preserving that precious liquidity, rather than doubling down on something that's clearly not working.
Speaking of digging graves, let's talk about probably the biggest source of bad decisions for retail investors: the hype train. Rule 4 is all about avoiding it.
Right. And this is where putting in the work for Rule 1 really, really pays off. The sources use this chilling phrase. By the time you hear about the super hot stock or the next big crypto coin on social media, it's usually already too late. You're not getting in early on the pump.
You're the exiliquidity.
Yeah.
Yeah, that phrase just cuts right through it. It perfectly defines your role. You're just the person providing the buying pressure so the earlier folks can sell and lock in their profits. You're facilitating their exit.
It's all about timing and how information loses value. A pump, a big run-up, it's most profitable right at the very beginning. As more people find out, as it runs harder, the value of knowing about it just erodes fast. The source material even gives some necessary real-world context here. It explicitly says insider trading or at least asymmetric information flow. It's very much alive. So if you're basing decisions on trending hashtags, you are definitely late to the party. Guaranteed.
Okay, so let's say we navigate all that. We follow the rules, do the research, manage risk, catch a good move. Rule 7 gives us the final piece of discipline needed. Take profits, not just screenshots.
Yes. This is about tangible results versus, just bragging rights. It's usually pretty easy to feel when things are getting overheated. When a stock or crypto or even a whole sector goes parabolic, just straight up. Now, the source points out a distinction here. If you're a super long-term, buy and hold for decades investor, maybe this rule isn't as critical day to day. But if you're trading more actively or holding for shorter periods, you need that discipline, that iron will, to actually sell and take some money off the table regularly. Remember, a realized gain sitting in your bank account, that's real capital. That buys you freedom, options, a screenshot. That's just proof of what could have been. Doesn't pay the bills. All right, shifting gears a bit to overall strategy, portfolio construction. Rule 8 hammers home the need to build a portfolio, not just bet everything on one or two things.
Diversification, sure, everyone talks about it, but hang on. If I've done all that super intense Rule 1 research on a few things I really believe in, why shouldn't I just concentrate my money there? Go big on my best ideas?
Because Rule 1 itself kind of limits you, doesn't it?
Yeah.
You physically can't do that level of deep fundamental research on like 50 different companies or projects. It's impossible. So diversification acknowledges that reality. Yeah, put your high conviction money into those few things you understand inside and out. But the rest of your capital, you spread it out. Safer bets, broader things like index funds maybe, things that don't need that constant intense scrutiny. It's about managing risk across the board, ensuring balance.
Ah, okay. That connects the dots nicely. And our source material actually gave a simple example, right? Like if you have $100.
Exactly. It was like maybe put $5, just 5%, into something higher risk like crypto,
Yeah.
and the other $95 into broader stocks like an index fund.
Yep.
It's a basic illustration, but it shows that deliberate weighting across different types of assets, really important.
And that brings us neatly to Rule 9, which feels like a lifesaver, especially when markets get choppy. Stay liquid. Keep some cash handy. What's the absolute worst feeling for an investor who's actually done their homework?
Oh, easy. Seeing a fantastic opportunity, maybe a company you love gets unfairly hammered down, a real juicy sale price pops up,
Yeah.
and you have zero cash, nothing on the sidelines to deploy. It's agonizing.
I can personally confirm that feeling is painful. The sources had a great way of framing it too. The market isn't always running away. It's constantly flashing up sales.
Every big dip, every crisis, it's essentially putting assets on sale. If you don't have cash ready, you just have to watch from the sidelines. You can't take advantage. So Rule 9 is about setting yourself up to win. Have that dry powder ready. Be greedy when others are fearful, as they say, but you need the cash to do it.
Okay, and finally, Rule 10 kind of ties it all together. Learn by experience. Get in the game.
Yeah, the sources basically say enough of the theory already. Drop the endless reading, the demo accounts.
Ditch the paper trading, ditch the textbooks, stop passively watching YouTube videos, actually join the market, put some skin in the game.
That's the best way to learn, hands down. And the advice is sensible. Start small, really small. Use an amount of cash. You're okay potentially losing it first. Then, as you learn, as your skills grow, as your confidence builds, you can gradually increase your size. Nothing teaches you faster than real money on the line. Real consequences, good or bad. Hashtag tag tags Bafishatro.
So there we have it, the 10 rules, and that core tension we talked about at the start, between intense effort and deliberate inaction. It seems like success, especially in these markets, isn't really about chasing those crazy viral gains. It's more about the sometimes tedious discipline of doing your homework rigorously, like Rule 1 demands, and pairing that with super strict rational risk management, like Rule 6 emphasizes.
Absolutely. And the ultimate prize, the big idea weaving through all these rules comes back to Rule 6. Capital and liquidity buy you freedom. This whole investing journey, it's not just about hitting some percentage target, it's about building a resilient financial base, something that gives you choices, options, the ability to act decisively when others are forced to panic or retreat. That's the real freedom.
Well said. Okay, so for you listening, our deep diver, here's something to chew on until next time, building on what we've unpacked today. If Rule 2 tells us that constant trading is often expensive and leads to bad decisions, how much of the time you currently spend gathering information might actually just be FOMO in disguise, looking for the next hot thing instead of focusing? And where, in your own strategy right now, could you maybe apply more of that discipline of doing nothing? Where could you let Rule 2 and Rule 6, patience and capital preservation, do more of the heavy lifting for your long-term results? Something to think about. We'll catch you on the next deep dive.